The Houston apartment market is in the midst of a high-stakes showdown. On one side, a tidal wave of new construction, thousands of units hitting the market. On the other, a shadow market of single-family rentals tempting renters away. Is this a recipe for disaster? Are we on the brink of an apartment apocalypse? This week, we're joined by industry insider Bruce McClenny, the author of a bombshell article on the state of the Houston housing market. He's crunched the numbers, studied the trends, and he's here to give us the unvarnished truth. Can Houston handle this wave of new apartments, or are we headed for a crash? Let's find out. I'm your host, Marcus Armstrong, and this is the Multifamily Review. Bruce, thank you so much for joining us today.
My pleasure.
I'm really excited. I see you've got a lot of data and stats laid out on physical paper in front of you. What do you have here for us?
Well, there's some cheat notes for me for sure. on statistics, I like to try to speak directly to the numbers sometimes, and I want to make sure I'm saying it correctly. But I think it's to help me feel comfortable and like make me feel like I'm back in my own office. All the paper scattered.
I have a terrible habit myself of having sticky notes with random numbers just kind of splayed over my desk, and people will come in and be like, "What's that number?" And one of my favorite things is being able to just recall in my catalog mind here, right? Like, oh, that's some statistic on that I just was saving. I might do something with that later. You strike me as a person who might do something pretty similar.
Yep, I got them on my computer. I've got them on my desk. Yeah, all the stickies.
Perfect. Well, you wrote a really fantastic article in Houston Apartment Association's Abode catalog, and it was titled Buckle Up, correct?
Thank you. Yes.
Yeah, I want to actually ask you a little bit about that article. So that article focuses on Houston's Class A apartment market being saturated. Could you elaborate on the performance of other assets within the Houston area?
We're going through a construction cycle, and everything lately that we look at it goes directly back to the lockdowns and COVID and all those kind of things, and then the reopening and the wild swings of supply and demand that we saw in so many industries. And what's coming around to the apartment industry is a supply bubble. And Houston is definitely participating in that. Houston has always been one of the key high development areas of the country. We've just got a lot of homegrown developers that keep our supply going, and rightly so, because we've got one of the fastest growing in population and job growth. We're very consistent in those aspects. So what we're facing right now is it's a 50-year high in new supply, and that was born in 21 when there was so much demand. Economy reopened, right? We were closed and had historic job losses in 20, and then in 21 it reopened and we had historic job growth, and with that there was another epidemic related concept of you can work anywhere, like you just move wherever you want to go. So the Sun Belt regions benefited greatly from migration from the coast, and New York and Philadelphia, DC, and California. We had 38,000 units of absorption in 21, and that is 2.5 times the normal run rate. And that was played out across the country, especially in the Sun Belt, where people were migrating and job growth was at historic highs. So those two things, generate the need for more housing. Occupancy went up and rents went way up. Okay, in Houston, it was more like 14, 15%, but in Austin, it was over 20%. The rent growth was amazing. So Houston participated in that. And so because of that, developers go, wow, we want to build into this strength. It's like all-time high occupancy. And we also continue to hear.
Everyone wants a piece of the pie.
Well, of course. But you want to build into the strength and strength we had. So that started a development cycle. And development cycles in the apartment industry take 2 years. So, and at the same time in 21, interest rates were really, really low. So, financing was, oh, wow, this is on a relative basis, this is better than any other time we've seen to try to develop something. So interest rates were all time low, although prices had gone up on, had started to rise on labor and materials and all those things. So all of a sudden in Houston, we were faced with, we're just delivered at 26,000 units, which is apartment data has been in business since 86. And there were probably more earlier than back in the 70s and the go-go 70s and 80s where they were developed, much more developed, but we've never seen that many units delivered. I mean, we've come close, over some of the years, 21,000, 22,000, something like that. So that set the stage for a lot of supply. And that's primarily A stuff, right? It comes in. I mean, there's other things coming in now, affordables coming in, but it's all primarily luxury type, high end kind of stuff, top of the market. And classification system is primarily based on level of rent.
So let's break that down. I think in your article you use the exact phrasing, the "build it and they will come" thesis, right? So that's not holding true to demand and not keeping pace with the supply. So you talked a lot about job growth and that type of stuff.
Right.
What else can you give us that's impacting, the apartment market today?
It's just bad timing because we had such tremendous job growth in 21 and 22. I mean, those 2 years were the best years pretty much anywhere you look at, any metro you look at. Those 2 years back to back were just fabulous for job growth, which is good. But it's starting to ramp down and so the direction of job growth is coming down, ramping down, and we're getting back to long-term averages. We were in Houston, we were 5.7%. In Austin, they were 10% job growth, in those years. So, coming down is not directionally good when the supply is going up. So that there's a little bit of rub there. Timing is everything to do with it. And what really makes me question things is that, we hear that we need, we're in a housing shortage, right? And
Mhm.
if we were in a housing shortage, it would seem like all those units or whatever would just be scooped right up. But no, it's too much to assimilate in an orderly manner. And so what the industry has to do, or those developers have to do, unfortunately, is they know that price attracts more residents. So lowering the price, and we're seeing, like in the Class A space, the Class A is down, around 2 to 3%
Mhm.
in rents over a year basis, say as of the end of May. And so rents come down, which is probably good because they went so high and have stayed quite high since the pandemic.
I believe that. I can still feel it in my wallet when I pay
Mhm.
my rent every single month. All right. So what you're saying here is one of the ways that we attract residents to fill occupancy, right, is by charging less rent. I mean, it's a kind of a simple demand tactic, but it does work. And in your article specifically, you mentioned that Houston's rent growth is less impacted than other major Texas cities. So you're painting this picture for us, and I just want to kind of figure out what specifically is Houston doing that has allowed it to remain relatively stable in comparison to maybe some of the other major Texas markets like Dallas and Austin and San Antonio.
It's more steady Eddie. It's more like don't go too high, don't go too low. You stay steadier. And San Antonio is very much the same way, even more so than Houston. Uh, Austin and Dallas are just mercurial. They just they really go in big and fast and hard, and so they really drove things up high, and they've come down the most. So it just kind of a balancing act as to how far you go up is maybe limiting how far you go down.
That actually makes a lot of sense. So let me actually take a bigger step back. We talked about Houston's major supply coming in being mostly Class A, and I kind of want to take a look at single family rentals. You mentioned it a little bit in the article, and I know it's a hot topic within the industry. So they are impacting the multifamily market, correct? These single family rentals, build to rent type things. So particularly in classes B, C, and D, what advice would you give to owners and operators and managers of these classes to remain competitive?
They don't want to hear what I have to say. Typically, when we have overbuilt situations, the other classes may slow down a little bit. For years and years and years, they're very, very stable. The C and the D class for sure, and part of the B class are renters by necessity. So those people that live in there just don't have the means to go out and buy a home. So they're going to be renters wherever they may be. But yet what we're seeing in the B, C, and D space is move outs. So all of a sudden, we're seeing move outs and occupancy going down like, this is not something I've ever seen. They're pretty stable. The occupancy doesn't go up or down a lot. But what we have seen since the drive up in the pandemic about the middle of 22, we've seen a steady march down exodus from B, C, and D product. Now, when I say B, C, and D product, I mean it pretty much stratifies and distributes all the properties that we follow into, say, for simplicity's sake, let's say in quartiles, right? Class A is the top priced quartile, B is the second, C is the third, and D. So you've got a distribution. So it covers all properties, and D would be the lowest priced group of properties to make comparisons with. We've seen people move out, and it's like, well, okay, so I do know that, as I said before, people that are in those classes of properties are going to be renters. People are moving out. Okay, so like Class C went from, at the end of 21 in Houston from 93.1% to 80. I'm looking at my notes now, right? So 89.8%, which is a 3.3% drop steadily from, the end of 21 to where we are today. So where are they going? I started researching it's single family rentals. So starting back at the Great Recession, right? When we had subprime problems and the biggest group of problems we had was in foreclosures on single family homes. And so the government called in big institutions like BlackRock and other kinds of institutional to buy that supply up. And they did. But now they had it and they said, okay, well, let's do something with it. So that started the rental of just one house over here in this market, this subdivision, and another one across the street, just single family homes spread out all over the place. And so from that point on, 15% to 20%, depending upon where you are, of all single family transactions since then have been going to institutions, and then also mom and pops like you and me that want to, pad their retirement or whatever and have extra income and say, well, I'm gonna buy this house and fix it up and rent it. And before all that, before the pandemic, it was more of the flippers, right? Mm-hmm. Let's buy them and flip them and keep them in the sale rotation. But now renting has become more the vogue, economically speaking. And so all of a sudden there's new supply. It's a shadow market, and all of a sudden we've got this, and because it's a shadow, you just don't know how much it is. Nobody can really quantify it, but it's been growing, and we know that. And it's attracting people out of what was stable apartments into single family rentals.
So compounding problems, it's definitely not a shadow market anymore, in the sense that, maybe it's not something we look at, but in the sense that we just don't know how large of a concern this is on our multifamily communities.
It's hard to quantify.
But it is driving people away from what was considered more of the stable classes, is what you're saying. So those people are electing to say, hey, I now have the ability to be in a single family home. I can't own it, but I can definitely rent it. So I can see how that can transpire. I have a question to you about developers back in 2021 when interest rates were so low. Looking at the national landscape here, how do you see interest rates and their ballooning effect that they've had since then as a potential economic downturn impacting our developers?
It's a big concern for me. And if you're listening to any kind of CNBC or Bloomberg or tuning into the business news, you are hearing that there's a problem looming with commercial real estate refinancing, because what happened in 21, they got all this financing, construction financing, and they do have they got a financing stack, right? They get little buckets of money from several different places to build the money and the equity they need to execute these deals. So a lot of it is short term, 3 to 5 year maturity. And so guess what?
We're coming up on that maturity.
24 is 3 years after 21 when all this was started. And there's tons of maturities coming on. And so not only was all this being built then, the other thing that happened in 21 was that transactions took place. There were more transactions than we've ever seen, on a factor of three, and they were being bought at incredibly high prices, low cap rates, like we've never seen, like four caps, which is, you know, it means that they were paying high prices for these properties. And the only way that you can get out of buying high is to build occupancy and to build rent or rent growth. Guess what's happened?
You're seeing that there's the ultimate downturn
It's
here,
going
huh?
down. Yeah. And so these, so they got in at a very high basis, and now all of a sudden it's coming to a point in time where they're going to have to refinance, and the valuations for real estate is that, well, your occupancy's down, your rent price is down, so your NOI is down. So guess what? That drives your cap rate up, and so like what was once worth X dollars is now anywhere 25 to 33% less than what it would be. So, but we've got this great thing that we've done since the Great Recession is something called extend and pretend. I don't know if you've heard that.
I was going to ask you about extend and pretend.
Yeah. So it's like, so the bankers, ones holding, these loans, and are saying, well, if you could just make your payments, if we could just work this out, we'll just, even though you're not technically meeting all the covenants and the underwriting, we can let this ride. And it's a good thing, because, what happened in 86 is that we didn't do that. It was like everything just went, we marked to market, and everything went under, and it was scorched earth, and we never recovered for 10 years or so after that. So it's better to maybe let it ride out a little bit. What's different this time around is that there's a tremendous amount of liquidity still out there. In other recessions and other times when we've gone through these maturity problems and financing problems, everybody was suffering from lack of liquidity. And nobody could really step in and save anything. But there's a lot of money sitting on the sidelines. But they don't want to pull the trigger, because what that means is somebody's going to take a haircut at 25% off their value. And even if they did find a way to make it go forward, they have to put up a lot more cash.
So Bruce, I was actually talking to an acquisitions manager about this exact same thing, but they were painting a slightly different picture currently. Like you're saying, people have kind of this bad debt and we're trying to extend and pretend. But another way is to say, okay, well, I want to offload this debt and I want to sell. And so I was talking to this acquisitions manager, and he was saying, look, there are deals that are available at discounted prices, 25, 30% off. He's like, but as soon as we put in an offer, someone comes in and swoops it up immediately, kind of alluding back to that high liquidation that you're seeing. When can we expect that, these actual discounted prices might stay discounted prices? How long can we extend for?
Like I was saying, we've been seeing this a while, right? It's like a slow moving wreck, right? I mean, we can see it coming, right? And it's just slow to come. And so because of that, everybody said, wow, we better prepare for this. So let's line up some capital. Let's talk to some people that we know that would like to participate in our deals. Let's get all this kind of lined out, planned for. And then when it really does come down to it, it's just really ends up being smooth in terms of not having to go through a default, or not having to go to foreclosure and all those kind of procedures. It just kind of gets rejiggered, refinanced, and recapitalized, and we're off and running again. And forget about the bodies on the side, okay, that we left, that were part of the past regime. But that's what's happening in a large way, and that's because of all that capital and liquidity sitting on the side, availability of all that.
Perfect. I think we should probably move away from some of the doom and gloom that we've been spreading here. It's unfortunate that
That's
the
doom
data.
and gloom.
Well, we paint this picture of maybe not everyone making it out. We talked about dead bodies on the side of the road.
Well, but I mean, that's what this time's about. Okay, it's wonderful opportunity for those that can take it. But unfortunately, those people that were unwise in 21 and just got caught up in the exuberance and all that was going on in 21 did not think about properly what might happen if interest rates were to go up.
That's actually been our thesis around here too. We've been really curious to see how that all plays out. But I want to transition this conversation now to asking about renter trends and behavior, right? So if I'm a developer or a property manager right now, with the rise of remote work kind of coming in, have you observed any other shifts in renter preference regarding any features? And I don't want to get you talking about amenities or anything like that, but I'm just curious, what can I do if I was one of these people to stay ahead of the curve?
I think what has occurred, and I'm not so into renter preferences so much. I just see the numbers of occupancies and rent trends and those kind of things. But one thing that we have seen is uh, more properties being built out in the suburbs. There's been after the Great Recession, uh, development ceased, and then all of a sudden, the only thing that would satisfy people with money that wanted to get started back in the apartments, building apartments, were you know super urban, high end stuff. They wanted like the luxury stuff. That's the only thing we're going to invest in urban areas. And so, but that was that out of that recession. Out of this, I wouldn't call it a recession, but it's definitely, we did have a small recession in 2020, right?
Mm-hmm.
We had 14% unemployment nationwide. And so it was kind of like a flash thing. But the government came in, fixed everything, showered us with money. That allowed people to move anywhere they wanted to, maybe move up in some respects, larger units. And so I think, some of the things, the development trends then said, well, we need to start planning for home offices and areas where they can conduct business. And so that happened. And so, we're in this cycle where it's kind of cycled out to the suburbs. We've also got these other cycles of build to rent, which is kind of a new concept. It's been going on in Phoenix and Arizona for 10, 12 years. And it's just finally migrated here. And that build to rent concept it's like, I don't understand why they call it build to rent. It's like, I've been in the apartment business for a long time and everybody I know is building to rent. So what's up with that? So, but basically what it is single family home builders that normally build to sell, all of a sudden switch to whatever they built, they were going to rent.
Mm-hmm. I actually see that. So my wife and I are looking for a new home ourselves, and we were debating on, are we going to stay in a single family? Are we going to do an apartment? And we went and looked at some brand new apartments that were being built. They're not quite open yet, but they were highlighting some of these work from home type amenities. One of them had a podcast room. Another one had something like
special for you.
Yeah, a little bit special for me, but also had something like a multimedia. I don't know how to I want to say this, but like a streamer room. Like if you wanted to set up and stream all day in this particular room, that's something that you could do. Now some of them had like the virtual golfing and that kind of stuff. A little bit more fun. So it's cool to see that kind of stuff happening. And you're right. I think the build to rent name is one of the silliest names that I've ever heard. And everything that we built here is for rent. Most people aren't trying to flip and sell actual apartment units. So final question for you, Bruce, here. Beyond just the numbers that you provided with us or provided to us today, which have been fantastic, what are some qualitative observations you've made about the Houston rental market? Do you notice anything special going on here? Anything that you didn't address within the article directly?
And this goes beyond Houston because I think all markets are experiencing very, very similar degrees of this problem or of this situation. Overbuilt, move out to single family rentals. I mean, every place is experiencing the same, especially where we're covering the 12 Sunbelt markets that we cover. So first thing is the construction cycle is that, we have all this stuff coming in 50-year high. Guess what? We're probably going to have a 50-year low to follow it. Costs are high, financing still staying high. And so we're starting to see permits come down. So all of a sudden it's going to flip. And it's just, once again, these extremes we have, and I call it a bubble, right? I mean, it's like we had a supply bubble and it's going to let out, it's going to let down. And then all of a sudden we're going to have this dearth of construction, relatively speaking. Mm-hmm. And that's going to be a problem because when you have more demand than supply, rents go up. That's the equation. That's the formula for rents going up. So all of a sudden in 2 years, we're going to have inflation again from rentals. And right now it's settling down. The other problem that bothers me about housing in general is the barbell nature of single family homes. The existing homes, the golden handcuffs, everybody's stuck, doesn't want to leave at 3% mortgages.
Mm-hmm.
And so, that market has dried up. The listings are down. People, it's like sales are really way down. Sales aren't happening. But the builders have figured it out. The builders are thriving. The D.R. Hortons, the Lennars,
Mm-hmm.
you name them, their stock is as high as it has ever been. And they were shocked when the interest rate started to go up in 22. Everything was just shocked for like 6 months. But then they said, oh, we got this figured out. We'll buy down the rates to a sweet spot, just under 6%. And that's what's driving them. So we've got so it's a very uneven single family market that's going to adjust somehow, some way. I don't know how. I don't know how to understand what's going to happen, when the existing single family homes come back. It probably would be okay. And then the rise of the single family rentals is a problem to me. I'm very much a traditionalist, and it's like, I believe so much in the of the American dream of owning a home, and now that's turning into renting a home. And so that's just how things change in the world we're in today.
Look, I'm still waiting on my American dream to follow through. I'd like to own a home at some point in time in my life. A little bit tired of being a millennial and living through every out there economic financial downturn that America has ever seen, right? Bruce, I tell you what, where can listeners go to learn more about your work and access the data that you have on the markets?
Well, our company is MRI Apartment Data, and you can find us that way. And so we collect information on apartments in Texas, in Arizona, Georgia, Florida, Tennessee, and North Carolina, 12 metro markets. We've been doing it a long time, as I was telling you, since '86.
Perfect. Thank you so much.
Thank you.
That was a sobering look at the state of the Houston apartment market. But as Bruce said, the trends we're seeing here are playing out on a national scale. So whether you're in Houston or Hartford, Phoenix, or Philadelphia, the challenges and opportunities facing multifamily are very similar. I want to give a huge thanks to Bruce McClenny for sharing his insights and expertise with us. This has been a masterclass in understanding the complex forces at play in the rental market. As always, please remember to like, share, and subscribe. And if you have any questions or you just feel like contacting us about anything, please remember you can always email us at podcast@jturnerresearch.com. This is Marcus Armstrong reminding you to stay informed, stay ahead of the curve, and stay tuned for more in-depth analysis of the multifamily world right here on the Multifamily Review.